give us just a snapshot of your take of this and where we go next?
So I think everyone about Evergrande, I've talked about it, I've talked about it on different platforms, but the thing is, when you mentioned that the local bonds are more stable, I think there is also
the perception
of the local bonds are more stable. But we have to think about the onshore market is very high grade driven. The most buyers are banks, insurances. So the natural high yield buyer is not really there. We have seen it in the past few default cases or close to default cases. All of a sudden, things gap down 10 points, 20 points because there's no natural buyer. So when it comes to liquidity, we always say that the dollar market, you actually get more liquidity compared to the onshore market for high yield, but not necessarily for high grade. So I think that's where the mismatch is. And that's where I think...
With the liquidity, it becomes more volatility, though.
But the thing is, I think we have to separate things out. We don't have to focus on where things are, and just because it's trading at 20, 30, and doesn't mean that it's going to go to zero. There are situations where the recovery rate is a lot higher than where the bond prices are because there's just no natural buy at this stage. But because when there's more distress involvement and there's more banks and trusts and AMCs coming in and dissect it, that's where the value comes in. So I think right now it's just a mismatch in the buyers and the sellers, and there's a lot of noise. But when we look back into this whole situation, I'm pretty sure that this is probably going to be a case example, and having more cases of how people are going to treat these defaults and lead to a better situation for the market investors.
Yeah, Eric, I was actually going to ask you then, I'm glad you brought it up, the liquidity conditions around offshore and onshore. So I want to ask you then about offshore and the dollar bonds. And you mentioned, of course, when you look at 24, 25 cents in the dollar, I know we're not supposed to talk about these specifics, though. What's the market mindset right now? The difference between this morning and, say, last week when it comes to Evergrande's dollar bonds?
I think right now the thing is there's actually not that broad-based of a buyer for Evergrande. I mean, there's a lot of institutional clients. Probably got out of Evergrande very early on. We actually got out very, very early on as well. When it comes to investing in China, you need to know about the policy. You need to know about catching the news. And what we do within Harvest, we have systems scanning 80% of every bond in the marketplace for social media headlines in mainstream media, and it picks up what's positive, what's negative, and then it contributes to our final decision. There's a lot of things when it comes into China that you just can't just look at backdate data and just seeing where the numbers are, and it has to be ongoing understanding of the policy.
Do you see this Evergrande story having a wider impact on credit, on the Asia high yield space?
I think it's test case thing, but I don't think the spillover is there. And there are situations where it's now becoming a lot more interesting, because where there's companies where you know that they have cash, they have financing channels, and they can repay perfectly fine, that it's actually spilled over and now is becoming a lot more attractive to come in and buy.
What sort of opportunities has this created? Because you've seen spreads widen a little bit, and that's against the backdrop of treasury yields just falling. So I can imagine the investment universe that you look after, Eric, is getting a lot of attention.
Sorry, you mean for the U.S. Treasuries or for the CGB?
China credits and high yield.
Yeah. So we actually feel that right now the objective of what the government really wants to do is to lower the financing costs. This is not what they want to see. So if everything is widening out, financing costs is going higher, this is going against from the policy objective and the policy direction. So whereas where we're less so focused on where the CGB levels are right now, we are actually thinking there's more opportunity in the credit spread to tighten, especially when yields are coming down lower. And historically, when you see into, say, the developed markets, where now there's $17 trillion of negative debt, then what leads to it is that the credit spreads tend to tighten because of the chase of yield. And we do expect that to replicate within onshore China as well.
A lot would depend on the debt profile here, wouldn't it? And does that work in favor of some of the companies we've been talking about?
The financing channels and the financing cycle in China is very short. It's not like where in the US or in Europe, where people are financing for 30 years or even longer. So right now it's coming where there's going to be a lot more smoothing. Liquidity is going to help. The timing is going to help. So I think what now is having people to understand and dissect and also have the appetite to pick up these credits.